crooked. There we go.
Go ahead and introduce yourself and I'll take you.
All right. So, David Brown, once again, most of y'all know me. We now know each other. I can't remember your name. Say it again. Abigail. Sorry. I have to. Emma. Emma. All right. All right. Let's cut that part out.
Emma, Abigail, exactly.
That's what I said. Let's listen, please. I'm trying to help educate y'all. So. What are y'all seeing out there other than the 102-degree heat? My car said 102 degrees just now. I know that's probably not right, but
really?
Yeah,
car's overheating.
It was very hot. It was very hot. I get, when you first get in your car, I think it's been in the sun. It's probably,
It has been so hot outside.
Yeah. Stay hydrated.
We need rain.
We do. My yard doesn't look like it's been mowed. I mean, it looks like when I mowed it 2 weeks ago. Mm-hmm. It doesn't look like it's grown at all, which is great in that way. Yeah.
I'm just tired of watering in the morning and at night. I'm like,
Are you watering your grass? Yeah.
my plants
Irrigation.
and stuff,
Oh yeah.
What would happen if you gave plants coffee instead of water?
No,
They grow really fast.
coffee grounds are good for nitrogen.
Caffeine.
Well, hey, what are you seeing in the real estate market, not in your night?
What's up, Big A? Oh, got a balanced breakfast here. I'm so mad. He's not meeting me.
A lot of hesitance, a lot of people still moving,
Mm-hmm.
a lot of out-of-town folks.
Mm-hmm. Yep.
People got to sell.
Yep.
They have to sell,
Yeah.
and they got to buy if they got to buy.
Yep. People are holding their nose at the rates and prices and.
Are you still seeing people hold out? Because, I mean, the Fed promised us at least 3 cuts.
Yeah. Liar.
Yeah.
And everybody
Yeah.
was like, the prediction right now would we'd be hanging around like 5.5, and now we're at, what, 6.8 or something?
Yeah. So I just checked it. 7.03 is the average 30-year fix supposedly. Not everyone gets that. I quoted one the other day, or I locked him at 6.625, but they're putting like 40% down. So, that kind of a down payment, you're going to get a better price. But it came with a point, maybe point and a half, something like that. And then likewise, I priced one with a client who had a 634 credit score, and it was north of 7. So, we're going to try to go FHA though. You get so much more. I mean, FHA is so much more forgiving with low credit scores than conventional.
Yeah.
Not only on the rate, but the PMI. The PMI gets hammered if you've got, say, less than a really 680, 700. It's so expensive. Yeah, multiple times. Whereas FHA is a flat rate. So, and they lowered it about a year. Was it last year, I think? They went from the factor's 0.85% of the loan amount divided by 12. They went to 0.55, so about a third.
Oh, that's good.
Better, yeah. So, if you got great credit, your conventional might be a little less than that. But if you've got bad credit, then might make sense to go that route.
Are you still busy?
Yeah,
You see
steady.
a lot?
Yeah, steady. I mean, it comes in waves. It feels like. And this is part of the stuff, but that's fine. Home equity is a constant conversation. I had a guy in my office this morning who I did his loan a year ago, and he's, with inflation and having to rack up some debt, he's exploring all options to, harness some of that home equity.
Was it my sister?
No, but no, I always think about like my audience when I'm talking about these things, make sure that it's not anyone's client or anything. But the guy's he's got a 6.25 rate, and at least a handful of times over the last year he's asked me, "Hey, rates down, can we refi?" Because he bought it kind of the very height of what he could afford, and I'm like, man, 6.25 is pretty darn good right now. So we don't want to, you don't want to refinance that. So, we have a HELOC vendor that'll go up to 89.99%. but there's a 45% debt to income max, and he bought at the max of his DTI, so he bought it like 48%, and so there's really no room there. So that conversation didn't end. I mean, it was a good conversation, but it was not a, hey, we can solve this problem for you by doing this. It was, if you're pinched, you may want to take on another job. Think about downsizing. And I actually showed him the house and said, hey, here's a house the client's buying for $300 that, market rent's $2,000. You could save $1,800 a month by, for a season renting. And, the guy can't afford health insurance. He's got kids getting braces. It's like, these are real things that people are dealing with just the cost of everything. And
Do you have any numbers on the amount of people that have increased their credit card debt?
do we need to start this, Karen? Are we
I think
rolling?
I started rolling.
Oh, did it? Okay. Sorry, so
The amount of people that are living on more credit card debt in the past year, I saw something like that. I
Yeah.
don't think you had seen anything like that.
I'm seeing more and more articles pop up about how we might have finally gotten through a lot of this stimulus and people saving. Like now people are to the point where they're relying more on credit cards. They're maybe maxing out their cards. They're turning to home equity. A lot of them are turning to home equity. And so we've seen in vendor partners we work with, like wholesale lenders, there's a huge explosion in that space. So, we've partnered with several. 3 kind of come to mind as the most. So we have a company called Figure Lending. It's all AI driven. And so there's no appraisal required. It's just AVMs. We do a soft credit pool. All we need is like 5 bits of information. So their date of birth, their address, their name, the household income. It does a soft pool, and within like 30 seconds we get offers from Figure. And it's a second or third lien product. Can be on primary, secondary, or investment. The downside to it is it's prime based, and so you're not going to get a 7.5% rate. You're going to get a 9, 10, 11%.
Yeah.
Maybe 12. And it's fully amortizing, so it's not an interest only program. So it might be a 15-year term. It might be a 20-year term. Based on their profile, it might be a 10-year term. And so, but it might be better than paying 10 on 10 different credit cards and small loans, and so and it's easy. That's application to funding in 2 weeks potentially. So hey man, come on through. So Figure's pretty cool. It's all the client just uploads their income docs, then they do a full credit pull at some point in the process. But it's very easy. It's kind of like the easy button for getting a home equity loan without having to go through the bank, get an appraisal, title work, and all that stuff. It's all very streamlined. And we're working on private labeling that too, to where it appears as if it's all our company, which doesn't really matter, but from a branding standpoint. We have a company called Symmetry Lending. I don't know if you've ever heard of them. Symmetry is a HELOC broker, so they partner with credit unions and banks all over the country to do that 89.99% HELOC. They'll do it as a piggyback on a purchase. So let's say you're buying a house for $1 million and don't want to do a jumbo loan, so you go up to this conforming limit of 726.2 or whatever that is, and then could do bridge the gap to that 10% down with a HELOC. So simultaneous closing, first HELOC.
Based upon like the value of that home.
Yep. Use the same appraisal. Yep. Mm-hmm. Yep. I'm doing one for a client. Now that's the one that's 45% DTI max.
In order to do that, would you have to have a substantial amount down to be able to tap into that equity to be able to turn around and do that HELOC?
Well, it remains a traditional HELOC in that once they buy the house with it, it stays in place. So as they pay that down, they can redraw on it, just like any other HELOC. Now there's a period where they have access to it, then it converts to P&I over, I think, 20 years. So that's pretty cool. I'm doing one for a past client of mine. He's got a house in Bluntville. It's paid off. he wants to go through me because we can go to 500,000 on that. His bank will only go to 250, so higher loan limits. So yeah, it's just and then I have another client right now. He's got very marginal credit at best, but he's got $60,000 of credit cards, and we're refinancing to a FHA loan. So I can think of 3 examples right now. So there's Symmetry that does HELOCs, there's Figure, and then we have another wholesaler. Freddie now is doing a second mortgage up to 30 years. So a lot of the second mortgages you see will only go maybe 10, 15, 20 years. This wholesaler will do through Freddie will do 30.
Are you seeing more 40-year loans?
No, I don't think there's much of a market in the secondary market for that. Kind of like ARMs right now. Do y'all see many people getting ARMs?
No, I did for a little.
Yeah, if you do, it's probably through a bank or credit union because.
I've seen more 40-year stuff with like investor types because
Yeah.
they get more cash flow.
Yeah, but if you look at the payment, it's not that much lower. Yeah, and you pay so much more interest. It's just. Yeah, that seemed to be a hot topic. It comes and goes. Oh, this is coming out, then it doesn't. Then it, yeah.
I thought FHA was like, hey, we can extend or something to 40 years or something like that at one point. Or something.
I'm not real sure. Yeah.
You don't know. It's just like a headline. What's going to happen?
Yeah. So anyway, so home equity, just constant conversation. So if y'all have clients who are thinking about buying investment property or leveraging.
My parents to do it today.
Yeah.
No. Like, okay, well, through your retirement, I guess.
Yeah. OPM, other people's money.
I think a lot of stuff that I'm seeing is just kind of clicked with what you're talking about as well. A lot of people have racked up a lot of debt here, but the thing that has given them the most amount of money is their house, and they need to access it.
Mm-hmm.
So I've had to sell someone's house in order for them to buy less of a house, but they were able to wipe their debt out
Right.
because their house grew in so much equity.
Yeah.
So that's for those of you who have been in here for at least 2 years. The conversations with your past clients that you need to be having is, you're just staying top of mind, chatting
Yep.
with them and being like, hey, how's everything? You're going to have massive rapport for them
Yep.
to be like, hey, I'm struggling. What do I do?
Right.
The guy I met with this morning, he said he had a friend goes to church with, just did that. They decided to downsize, clear off a bunch of debt, and kind of hit the reset button.
Yep.
And it just creates some margin. You think about the cost of things going up, and if we're all getting older, we're all at some point we like to maybe not have to work, and so what are we doing towards retirement, that sort of thing.
Mm-hmm.
Investment properties. Yeah.
Folks that have bought something with stairs, they had the ability to do it. It takes one trip to where those stairs are now inaccessible, and they got to sell.
100%.
Mm-hmm.
So, that's really just not like, hey, let's make money, but that's, hey, how can I help folks get to something to where they can even get some equity out, downsize, and now they're good.
Yeah.
Yeah.
They're ready to go to assisted living.
Yeah. So I'll share this with you guys because this dominated my morning. And you may experience this with other lenders too because it's industry wide. But the agencies, Fannie and Freddie primarily, are really scrutinizing every loan that's coming in through the door. Volume is down in our industry. I think lenders have pushed harder to get deals, and for whatever reason on the secondary market, those loans are being really scrutinized. And so what happens is that pressure then gets put on underwriters to be exceptionally thorough. Maybe not over-condition a file, but maybe sometimes over-conditioning a file, which means feel-good conditions. And so when we get a conditional approval back, our instinct is always to look through these conditions. And before I go back to this borrower saying, hey, we need this, this, and this, like, do we really need this, or are these feel-good conditions? So what we're seeing is this loan gets done, it gets sold to Fannie or Freddie, and a month later, 2 months later, an auditor has reviewed it, which every loan is being audited right now. And they're saying, hey, we don't think that you adequately wrote this loan, and therefore we're going to make you repurchase it or fine you for not underwriting it correctly. So
Has anyone here had their deal be audited in the middle of their deal?
like towards the end of it where you get a quality control audit? Yeah, that happens from time to time. Yeah.
I've never had it. I had an agent here
Yeah.
called I pushed price per square foot on this place. And
Yeah.
I was like,
Yeah.
here's what it's worth. You can get this.
Mhm.
So we'll see. And they got that. It appraised. And then, like, as they were wrapping up a week before closing, Eastman was like, hey, we're doing an audit on this because we think that price per square foot is too high. And I was like,
Okay, you do summarize that.
then it came
Did you
back
have
and
in
they had
mind?
to drop
Yeah.
it.
Yeah. So.
Oh, shoot.
So Matt's talking about questions that come up while they're underwriting the loan and the legitimacy of an appraisal based on the square footage the appraiser is acknowledging or coming up with. And I can't speak for credit unions because they operate differently, but in our world, we might have a quality control audit near the end of the process before funding, just to make sure that all the I's are dotted, T's are crossed. And it doesn't happen all the time. Maybe, I don't know, 5 or 10% of the loans we do might have a QC audit towards the end. Is this on? Now, the appraisal, in our world, the underwriter's always going to review it. Most of the time, there's no issue. Sometimes they may say, well, we're not sure these comps are right or whatever, or we need you to address this or that. And most of the time, the appraiser does it, and there's no issues around that. Pretty rare we see. I mean, y'all know Danny Santucci that comes. I mean, he does probably 95% of our work, and he's been doing this for 20-some years, so we don't really see any issues with appraisals. Thankfully, not to say we'd never do, but it's pretty rare. But yeah, loans getting audited is very common right now, especially right now.
Is it because we're having more people default?
Yep, more delinquencies are up. So, gosh, there's a lot of different directions we can go here with that. FHA will actually allow a lender to get a 500 credit score and do a loan.
500?
Yep. Mm-hmm. So companies will put overlays on that, right? So we'll say, well, we Sierra Pacific will only go down to 620. Well, we're about to lower that. And I don't know. Like, there's two schools of thought. I mean, there's an argument for both ways. There's a segment of the population that has low credit, and they're good borrowers.
Right.
Something's happened. There's also clients with low credit who there's a reason there's low credit, right? Like, if it walks like a duck, yeah. So we're going to be going down, I think, to 580 maybe. But there's last I heard, there's like 30%.
Get down to a 400, I'll be sending you all the time.
Yeah. Well, the thing is like, you hear companies promote, oh, we'll go down to this score, and that sounds good. But then when you have a client that has that score, you still have to be able to get them through what's called manual underwriting, or it still has to be eligible through Ginnie Mae or Fannie or Freddie.
And everything's so expensive, right?
Yeah. But just getting them approved, even because a credit approval is not just based on credit score. It's like one of the boxes you check, right?
Correct.
And so Fannie or Freddie or Ginnie might say, well, we can do it, but they have to have this much in reserves. Their DTI can't be over this. All these other things,
Right.
where they may not be able to check those boxes. So leading with credit score, it's a kind of more of a marketing thing, I think, than a reality.
Mm-hmm.
Like if you look at a lender and like what percentage of their loans were to, 580 borrowers, maybe less than 1%. So
Dang.
yeah. So
If Dave Ramsey's correct, can you have a 0 credit score?
yeah.
Still-
Yeah, it's actually just a not determinable score. After 6
You have
months.
Good income. Not a whole lot. Like
Well, you're talking about like a manual underwrite.
Yeah, like somebody
Yeah.
comes to you, they're like, I'm a cash person. I only done cash.
Yeah.
But
I had someone. Yeah.
the Ramsey's is like, you don't
Yeah,
need credit.
and Churchill Mortgage is out of Nashville. They've kind of made Matt's. I'll say what Matt said. Talking about Dave Ramsey and the no credit score and manual underwriting, to where if you don't have a credit score, you do other forms of credit like utilities, insurance, or other ways to verify someone has paid their bills. Churchill Mortgage is a company that does it well because Dave endorses them. Companies like us, here's an example of an overlay. We need at least one score from one of the three bureaus. So we at least need a TransUnion, an Equifax, or an Experian score. If there's nothing for the other two, that's fine, but we have to have one.
Are there some credit cards that only report to one or the other, or do they all report to all three?
There's some creditors that do, like some banks might only report to Experian, for example, or one of the bureaus. Some lenders might. Most, like if it's a name brand card or a bank that you're familiar with, usually will report to all three. And it's really obvious when we pull scores because like sometimes we'll get a report where they've got like a 620 and then like a 750 and a 770. It's like, well, obviously something's being reported to this bureau that's not being reported to the others. But it's not that common. Yeah. So.
But isn't it true, David, that you can have credit and have a good credit score because you have credit cards and you keep them paid down?
Yeah.
Or
Yeah.
you get them down to zero. You get several down to zero and close out the account. Does that still show up on your credit?
Yeah. So when you have cards that you've managed well, you've paid down. When we run credit though, it's a snapshot of that borrower situation at that time, and it's going to reflect how recently those accounts have reported to the credit bureau.
Right.
So when we pull credit, most people have a few cards they use. Maybe they pay them off, but at that point in time, it might show, they owe $1,000 to Discover. It's like, well, I pay that off every month. Okay, well, it's reporting this, so we have to use the minimum payment that's associated to it. Usually it's $25, $35, and it doesn't really impact debt to income ratio. Sometimes it does, and so we might get into the underwriting and say, well, we need to have a statement from you showing us a zero balance in order to admit that payment. But I think back to your question. The easiest way to improve or keep a good credit score is one, pay your bills on time. Don't let anything go past 30 days. But keep the utilization low. So the amount you owe relative to the credit limit,
Correct.
usually less than a third. So less than say 30% of the balance. We all the time are having to do rescores for people where, they have a card that reported a higher balance, and because of that ratio, their score is down. But if we can bump it up maybe 20 or 30 points, we could really improve their rate or get them maybe into a better program. And so we have some software that we'll run, and it'll say, hey, if they pay X amount towards their Visa card, there's a 97% likelihood it'll go from here to here. And so we give those instructions to the client. They get us a statement showing they've done it. We do a rapid rescore. Usually within 3 to 5 days, we have a new score.
But if people have one or more credit cards maxed out, that's not going to be a good credit score.
That's going to really hurt their
That's
score.
what really hurt them.
If you have any cards maxed out,
Don't
or
call me out, Karen.
yeah, if you have cards that are close to the limit, or even over 50 or 60% of the balance, it's going to drag.
Yeah.
And it's a catch-22 because right now I've got a client, one of the second mortgages we're doing, he's trying to pay off his debt, but because his debt is so high, it brings his score down, so it's affecting his rate. It's like, well, if I pay these cars off, it'll well,
Kind of.
it will, but we need to do the loan first before he can pay it down. So his thought is, well, I'll do it now, and then when rates come down, I'll just refinance again, and his credit should be better. So.
What about folks that are like, you know what, I finally got out of credit card debt, I can't wait to just close down this account.
Yeah, I was just going to say, keeping cards open is really important. People are trying to maintain a good credit score. Paying that card to a zero balance is great, but don't close it.
Do you suggest opening multiple accounts and just keeping them open?
Yeah.
As long as we're using them.
Yeah, I mean, not like 15 or 20, but maybe 3 or 4.
Like I'm not wanting to have a bunch of cards, but
Hey, you're welcome.
but I've been thinking, like my score's been staying like high 7s, and I'm like, I want to get that. I want to make it go up.
The golden age.
If you're over 760, 780, you're not really gaining much. I mean,
He can't tell his friends that he's at 800.
I want to be
Yeah.
800. I want to grab
Yeah.
his hand and be
yeah.
like,
Yeah. So Fannie and Freddie, they got a little more granular with the tiers, but I think anything over a 780 now, you're not really gaining anything like for a rate, like a mortgage rate. But now I'll see people pay off like a car loan, and that'll actually drop their score. They're eliminating a trade line because that term loan ends, and so it's now a historical loan that's gone, and so it's one less trade line they have that's active and open.
Really?
Yeah.
Is it better to just pay the interest on it and make
Well,
it a lower payment?
Most lenders won't allow that. Like, I guess you could do well. You wouldn't want to do a partial payment because they may consider you past due if you're not paying the full payment.
If it's up, it's up. I think the best way to do it is because like
I usually
You
pay
have-
it twice a month.
you have multiple. It's great because I know your situation. That works great. You're wanting to keep multiple lines of credit. So this is if somebody's credit is like on the margin, and one of the big things is going to be because there's fixed credit, there's revolving credit, right? So if your fixed credit goes away, well now they're just looking at the revolving. This one's finished, so then you
Yeah.
have that dip. So I'm not saying go buy a new car and get a new loan, but I think too, and David might have insight on it. If you're having multiple lines of credit that are available, like I always look to push my credit limit, even though I don't. It doesn't
Yeah.
ever change. I always look to see how much I can get.
Yes.
Because then if you use a little bit of it and you're constantly paying it, it shows that you're a good borrower. You're good. You're going to have a good score on that side. So I have a lot open on that side. So even when the car stops, it'll dip a little bit, but then there's still everything that's there to as far as what's open and being circulated on your credit.
Yep. Yeah, monitoring what's out there is very important. Annualcreditreport.com is the government-sponsored entity that allows you to get that. It used to be once a year. I think since COVID, you're now able to get it anytime. So you can pull your reports.
Your actual credit report, not
Your
Credit Karma.
Right. It won't give you a score unless you pay an extra like $8 or something. Yeah. But the point is to make sure what you think is out there and open is actually what's out there and open.
I use my credit cards, and I will open up the TransUnion. I can see most of what I have. Is that similar to that? Or it's just kind of a feature that the credit cards have?
As far as showing you what's open and active,
Yeah, I get to see like open lines, closed lines.
like giving you like a total dollar amount.
Yeah, this much on this house.
Yeah. I mean, it's an indicator. I don't know that it's 100% accurate.
The money.
Yeah, and I think too, like for your clients, something to make sure they understand, or I think that's going to be important to them is what they see on their app or their Credit Karma app isn't going to be necessarily what we pull, because a mortgage score is going to be different than that.
Is it the middle score that y'all take? Or do you
Well, it is, but even if it's the same bureau, like they could pull their TransUnion through their app or Credit Karma, and it's going to be different than our TransUnion score because it's a mortgage FICO model score versus maybe a revolving. Same with the car dealership. They go to the car dealership, it's like, oh, they say my credit's this, which is probably going to be different than their card app and different than our mortgage score. Super hard to explain to clients. Yes, I mean, like,
They're like, oh, so y'all are just making this up.
yeah. It's like, well, they told me, I had a client today email me because I said, well, hey, your score is this. So it was like a 685. And he said, well, my TransUnion says I'm 714. Like, well, that's what you see there, but what we see is different. It's a mortgage score. So sometimes that helps people who've had really good mortgage history versus, and then it could hurt maybe that first-time homebuyer who's just had credit card history.
Right.
But usually there's not that huge of a gap. It might, it's not like, oh, it's 600 here and 800 here. I mean, it's, a little closer. So, what else y'all thinking about?
How about the life of the loan? Because most people, if I say, hey, the lender wants more documentation, they're like, oh, I already gave him all that information. What's happening? So kind of explaining a little bit about what a loan officer does when it gets passed off to an underwriter, why that underwriter is there, and then what does it mean to be
conditionally approved.
Yes.
Yeah.
Condition approved, and then
Yeah.
finally approved.
Yeah, I've tried to get in a habit of telling clients like, hey, we're going to get a set of documentation from you, and once we get a fairly complete file, we don't always wait till it's 100% complete because we want to at least get the timeline going. Within 48 hours, we have a conditional approval that comes back. And it's going to be a conditional approval, even if it's probably going to be a decline, just because the underwriter is going to say, hey, it's approved if you can figure out this, this, and this, right? So what we try to do is submit a file that's going to have minimal conditions coming back. Usually loan officer conditions or processing conditions, if we can keep that to, say, less than 10, then we're probably going to have a pretty easy time. It depends on what they are. But some of those conditions are things like appraisal, title work. So some of those conditions we're going to take care of for the client. They don't even know that they're conditions. And then my processor, who I think most of y'all met, Jessica, she's going to send an email to the client. She's going to parse through those conditions and say, hey, your loan's been approved subject to the following conditions. Before that, I'm trying to set the expectation of the client that, hey, we're going to send your file in, and it's going to come back with a conditional approval. Now, it's very typical for us to have to ask you for more information. So when they hear that, I think they're already like, okay, this is typical. It's very typical for us to have to go back to the client 2 or 3 times for more stuff, because a lot of times what we send into underwriting may, open Pandora's box. It might say, oh, well now, here's this. We need to know about this and this, or conditions can beget more conditions sometimes. Mm-hmm. It's just the nature of what we do. This bank statement has a large deposit on it. What was this? So I think framing that in a way that the client gets it, that, hey, this is just part of the dance we have to play, it's important so that they're not like, well, I gave you everything you asked for. I gave you everything in a pint of blood. It's just our business. So I think it's on us as loan officers to try to get as complete a file up front, make sure we can recognize any potential issues so that when we get it back, it's not completely out of left field, and like, why are they needing this? Or, so that's where we have to explain why and kind of.
I try to have those conversations with anyone who's getting a mortgage, though. It's like, don't get mad at them. This is how the process works. There's an underwriter.
Yeah.
They're going to ask for all the
Don't
annoying
hate the
stuff.
player,
And
hate
this
the
is just
game.
the
Yeah.
person bringing that
Yeah,
information.
and some of your elderly clients sometimes are the hardest because they don't understand. Like, hey, well, I've owned a house for 30. I had a couple that closed last month, and they were moving from out of state. So older folks typically have a hard time with technology. So finding documents online or sending information. They don't understand, maybe it's been 40 years since they bought a house. They don't understand why there's so much,
Paperwork.
don't hate the game.
Yeah.
Don't hate the player, hate the, it's just getting a mortgage is not fun. I wish every borrower was W-2 on their job for 2 years, 800 credit score.
That's something too to kind of talk to us about too. There's a big difference between what he's just said of a W-2 person.
Yes.
It's like, hey, here's your guaranteed hours.
Yep.
Here's your guaranteed time off, as opposed to like we're all nightmares when we call them. Just so y'all know.
Or
We're like,
100.
hey, Dave,
No.
house. It's like,
Yeah.
oh my grief. Okay, like it's this.
Yeah.
You have this.
Oh, from a realtor to apply? Yeah.
Realtors, like,
Yeah.
Hey, we're doing this.
Yeah.
And most of them are married to some sort of construction worker or something. And it's like,
Well, it's funny you say that. I have a realtor right now I'm trying to help with another brokerage, and
she's married to a
she's
doctor.
been in the business for 2 years, but she didn't file a return the first year because the accountant advised not to, and now the accountant doesn't want to amend it because it would throw off the Social Security reporting. And I need her income because the husband's a contractor, and he writes off, and so yeah, I mean, yeah. So anyone that's self-employed that gets a 1099, or and this is where we see deals fall apart a lot. I mean, when we haven't properly vetted their income, like nurses can be tough. Surgical techs, people who are.
Overtime.
Or well, not even overtime. It's variable hours or erratic pay, where if they haven't been on the new job and yet or maybe a travel nurse, they haven't been on the new job for at least 12 months. We have to have 12 months of commission people who change jobs. You generally have to have 12 months of new history to substantiate their new income, even though they may have been doing it for 20 years.
Really? Even if it's in the same field?
Yep. If they change jobs and it's variable pay, generally we have to have 12 months of new history.
Variable pay.
Commission,
Is it like a-
variable hours.
Like a base pay plus commission would be variable, or is it just all? Pure
Could be.
commission?
Otherwise, we might have to just go off the base pay.
Okay, that would suck.
Mm-hmm.
Okay.
Yeah.
And that person needs to be at least there for 1 year.
Yeah. Generally speaking. Yeah. Yeah.
Rule of thumb. Okay.
Mm-hmm. So financial advisors who are commission paid, nurses, realtors,
Any sales jobs?
sales jobs. Yeah. Yeah. Yeah.
Sticky.
Yeah.
Would you then have to go off like bank statement loan? Would that be helpful?
That's a possibility.
'Cause I know some people too. Like I
Mhm.
know somebody that owns a business here, and he was trying to buy a house, and I told him, "Hey, you're gonna need your tax statement, stuff like that." Man, well, on paper, I don't make a lot. He's like, "But I make, I'm like, "Well, you're host."
Just helped a guy in Florida, longtime commercial client, used to have, owns a business here, bought a third home in Daytona Beach. And,
It's a real poor guy.
yeah, well, and he's one of these guys like, oh, I borrowed more for you. I've never had problems. It's like, well, based on how you file your tax returns,
Yeah.
I can't, so we had to do a bank statement loan, and we got it done. And, he paid probably a point higher than market rate, but he was thrilled as could be.
Yeah. That's good to know.
Yeah. So that's something new for us. We're now doing and we're not just brokering bank statement. We're actually now doing those in-house
Okay.
through our Sierra underwriters and processors.
Speaking of in-house, can you talk more about how appraisers are picked and how Danny is able to get like 95% of your stuff?
I can't reveal how the sausage is made too much here. This is still being recorded now.
Is this
Um,
Danny?
So
Is this Danny?
is this public or is this just
No, it's private.
okay? Pardon?
Can turn it off. You can turn it off.
Yeah.
So that